What's up, apes? Hope everybody's doing well, and thank you for tuning in once again for another Daily Peel video stream of the day. We're here to get you ready for markets tomorrow, get those portfolios all fired up and ready for the ticker tape. It is currently Wednesday, May 29th, beautiful Wednesday, 7:27 p.m. here, and like I said, we are talking all things Daily Peel and all things markets for tomorrow, so make sure to stay tuned and get all prepared, find out which stocks we should be looking at, which stocks we should be throwing up on top of. We're going to be talking also about excess savings, where all the money is going, how we can be following that money and maybe make some money of our own off of that. And then, of course, we're going to be talking about the Bank of Japan. I thought Jerome Powell was good at pumping stocks. They got absolutely nothing on Japan. So we'll get into all of that in just a quick minute. But, of course, thank you, everybody, for joining us here once again. All right, let's go ahead and get right into it. So the WSO Alpha portfolio, I gotta say, it was a great day for us. We were down about 96 basis points, so we outperformed both the S&P and the NASDAQ because the S&P was down like 20 basis points and the NASDAQ was down about 58 basis points for the session. So I'm pretty sure that means we outperformed, right? It was a bigger number, and yes, it was all the way lower, but still, a bigger number wins, right? It's kind of like how I was explaining to my softball team the other week that I would so much rather hit like a line drive to center field and have somebody catch it than hit like a dinky little ground ball that goes by the first baseman and allows me to get a single. Like, it doesn't make any sense. It just feels better to have that bigger number. All right, let's go ahead and get into some of the banana bits of the session here. First and foremost, at the close today, Salesforce reported earnings, and it was one of the biggest mistakes that the company has ever made, just being way too honest. They came a little bit short of revenue estimates, and the stock is down 16% after hours. It's the first time that this company has missed a revenue estimate since 2006. So pretty insane. That's the damn Bush administration, and the GFC hadn't even happened at that point. So wild stuff going on over at Salesforce. Big Oil is flexing its big fucking pollutive muscles today, and honestly, I kind of love to see it. ExxonMobil basically told a bunch of activist shareholders to fuck off and quit all that liberal shit, trying to force them to adopt. Basically, there was activist shareholder groups that were trying to get them to adopt these emission standards within the company's business operations, and they said absolutely fuck all that. Unless we're legally forced to do it, we are not going to do it. And gotta say, kind of respect them standing on business like that. Dick's Sporting Goods and 𝗪𝗡𝗪, speaking of standing on business, we were talking about both of these retailers because they both dropped earnings here yesterday, and their stocks went to the absolute moon. So it's not all retailers that are fucking up, it's just the shitty ones like Target and Walmart, apparently. Finally, don't ever let anybody tell you that memeing can't take you far in life. I mean, the king of memes himself, Mr. Elon Musk, it turns out that Donald Trump is actually going to be inviting him to take an advisory role in his, his cabinet, if Trump is fortunate enough to actually win the election. By the way, I said fortunate enough for him, I'm not espousing my own views here. We don't get political at the Daily Peel. But he did say that he would like to bring Elon Musk on for a seat. I mean, that is, let's just leave it at that. Donald Trump and Elon Musk are going to run the country for us, okay? Doesn't that sound great? It doesn't sound like a fucking disastrous sci-fi novel or anything else like that. Anyway, let's go ahead and move on into our main macro story. We are playing economic hide and seek today, and our target is none other than excess savings. I was never particularly good at hide and seek, mostly because having asthma as a child and being a relatively large person makes hiding a little bit difficult, especially when staying quiet is part of the game. But finding excess savings was pretty easy, so it turns out we might be getting better at this whole seeking thing, but the whole hiding part, yeah, we got a lot of work to do on that. So if we go ahead and take a step back and start to look at news stories, macro news since the pandemic has kind of receded, one of the biggest stories has been the run-up in excess savings. So that is displayed by this chart here from Bank of America. They're showing us that run-up in excess savings. Believe it or not, it goes in this direction, even though I think it looks mirrored from your angle. Just don't trust your eyes for a second. Trust me. And what we see here is that excess savings, January 2020, all the way down here, it's pinned to 100 as kind of the starting point, being 2019, ran all the way up to, about twice the average level in 2019, and is now falling back down across every single income spectrum, is seeing their excess savings rates decline slightly. And so it's falling down. It's in a range between the, 135 to like 170th percentile, depending on your income bracket. Believe it or not, this highest one, that blue line, is actually lower income consumers, people who make less than $50,000 per year. So we saw this big run up in excess savings, and it's kind of started to slowly dwindle, but it's been 3 years, and there was a huge spending boom in 2021 and 2022. So it's like, why is this stuff still just kind of dripping through? Like, it's not completely getting sucked away, like we might expect if there was a spending boom or a recession and people like needed money right now or something like that. But it's also not continuing to rise. So clearly people are keeping up that same savings rate. And yes, obviously this was initiated by Biden and Trump dumping a shit ton of helicopter money onto the economy in 2020 and 2021. So we know why it's there. We know where some of it is going, but we haven't really been able to identify where the rest of it is going. However, if we start to look at some other data based on investor actions over the past couple of weeks, months, and years, we can start to kind of piece the puzzle together here. So I think this is the missing link right here, and it's great that you guys cannot see this line whatsoever because this chart is the entire point of the fucking article. But anyway, this is basically showing non-competitive bids at treasury auctions. I know that might have sounded like fucking Chinese to most people out there, but basically what that means for the non-nerds among us is the U.S. Treasury, when they sell bonds, they do so via an auction process, and you're either a competitive bidder or a non-competitive bidder. A competitive bidder is somebody who is bidding, saying like, I am offering this yield for this many Treasury bonds, and then the Treasury will basically take in all of those competitive bids. They'll find basically the median yield and issue the entire auction at that yield level. So these competitive bidders, obviously everybody wants to be as close to that accurate price as they possibly can be. While non-competitive bidders, this is retail investors, okay? So this is you and me going on treasurydirect.com, if you can figure out how to use that fucking 1730s website right there, versus, or it's like your broker calling in and trying to purchase this stuff for you, whereas the competitive bids is like institutions. You're going up against JP Morgan, Bank of America, people who actually know what they're doing and talk about. So non-competitive bids are a great proxy for retail interest in treasury bonds, and we're seeing this absolutely explode. It really started here in about July of 2022. What do you know? That's exactly when this huge jump up in excess savings started to decline a little bit. So I think that missing piece in the excess savings puzzle is because investors are starting to pour into treasuries. And why wouldn't they be? Because treasuries are yielding insanely high yields right now. So what we're looking at now is, of course, the 2-year yield. This is a 3-year chart, and it's at about 5% right now. It's flirting with 5% in the same way that a frat bro flirts with chicks on a girl's night out. And, you know, at the same time, investors buying these treasuries or buying these yields are kind of discovering, like, wait a minute, my savings deposit at Chase are only giving me 0.1% on my money, whereas I could get 5% with the U.S. Treasury if I just lock my money up for 2 years. So we figured out how to move cash that was sitting in a brokerage account, but in like a sweep account, into a money market fund. We figured that out nice and easy, but moving savings into the bond market has taken a little bit longer. And, you know, it makes sense because most people who are going to be driving a lot of this money, they're not sitting on there like me watching fucking CNBC and like listening to this shit. So they are kind of waiting to hear this from their broker. It's a bit of a process before it gets down to Main Street, but nonetheless, it seems like Main Street has finally figured it out. So that's kind of what I think is kind of going on right now. I guess it's good to see. I mean, I'd much rather be pumping treasury yields than pumping GameStop and fucking AMC. But the other big thing to take away here is we've heard this theory that rising rates could actually be causing the economy to expand more rapidly than it is by drastically increasing incomes, especially for wealthier people who can buy this shit. What if it's actually pumping the stock market too? We know that the stock market is not the economy. So what if people are earning these ridiculous interest payments and then just reallocating into equities for longer term holdings like Nvidia or like these index funds that have jumped up or ETFs and shit like that? I don't know. This could be another reason the markets are doing super well. Just talking shit right now, quite honestly. It's wild speculation, but that's what we do best here at the Daily Peel, and that's what we are always here to bring for you. So let's go ahead and move on into some of our stock movers of the day. In terms of what's right, we have Chewy. Chewy absolutely popping up lately. My dog is completely hyped. He's been telling me to buy this thing for quite a while because that's where we buy all of his food, toys, and the other shit that he just absolutely destroys are all from this website. And despite the fact that he's absolutely terrified of the boxes themselves, he loves what's actually inside of them. So the stock is up 27.1% for the session today, and that was on the back of very good earnings. They reported 31 cents a share on $2.88 billion in sales versus 21 cents a share on $2.85 billion in sales that was expected. Now, the big reason for this is because of 6.4% annual growth in their auto ship program, which is basically when pet owners, notably not pet parents, anybody who says pet parents, you should remove them from their lives. You should probably call the police, quite honestly. But auto ship, this is basically like a recurring subscription where pet owners can just say, yes, send me X amount of food per month or X amount of medicines per month or whatever the fuck else that their animal needs. And this is obviously cheaper for Chewy because it doesn't really require anything besides having the technology set up. There's hardly any variable cost besides the shipping fee. So this is improving margins as part of the revenue mix. They increased margins for the rest of the year outlook, and boom, shares were off to the races again, up 27.1% today. Kind of makes Marathon Oil look like a bit of a pussy here because they were up only 8.4% for the session. That's Marathon Oil once again. That's on a $17.1 billion acquisition by ConocoPhillips. ConocoPhillips, one of the largest oil producers in the U.S. I think they're third after Exxon and Chevron. Then comes Conoco. They're definitely going to be third after this acquisition. And basically, just like all the other big oil firms, they are buying smaller rivals in order to secure oil and gas drilling rights in different regions around the United States. So it was up 8.4%. The CEO said he expects a Shale 2.0 era in the U.S., which is very much like the CEO of like a fucking beer company deciding that like a certain day of the year is all of a sudden like the beer holiday. Like it's just creating this demand, creating this narrative so that he can pump his own share price. Moving on down below, doing the exact opposite is American Airlines, down 13.5% on the day. They fired their former chief revenue officer and now former chief commercial officer, a man by the name of 𝗪𝗏𝗪𝗀𝗪, excuse me. They basically were looking for somebody to blame for the reason that American is doing so shitty compared to United and Delta. They've been having a very tough time getting business class travelers back on their planes, probably because their planes are absolute dog shit. They're completely uncomfortable and they usually don't have charging outlets, but that's completely beside the point. They basically are expecting unit revenues to fall 6% this year because those high-ticket business customers aren't going to be there anymore, so they're struggling to improve margins. And a lot of this is also due to the fact that they've been leaning heavily on third-party ticket providers. So basically anything besides AAL.com or whatever the fucking website is, they have been relying on those companies to book their flights. That's going to hurt the margin for the end airline. So Delta and United have done a much better job keeping that in-house and collecting all that beautiful data from their customers in the meantime. Finally, we have Advance Auto Parts. This was the biggest Mandela effect that I have ever felt in my entire life. I could have sworn this company was called Advanced Auto Parts. I was about to call my dad just to make sure I wasn't going completely crazy, but no, it is called Advance Auto Parts. And whatever you want to call him, you could, really the only thing to call him on the day on Wednesday was an absolute piece of shit because the stock was down 11% on the session. The vibes were off. It was a tough earnings report. And the CEO basically blamed everything from the weather to uncertainty about the balance of the year. Whatever the fuck that means, he's just saying in corporate lingo that the vibes are off. That's all that happened. Volume declined because this is kind of like the worst place that you could be in right now, quite honestly. They are facing heavy volume declines because obviously nobody's going to buy auto parts right now that are inflated to fucking hell unless they absolutely have to. And nobody's buying a new car right now because interest rates are absolutely through the roof. So, they're in a tough spot. They're kind of caught between a rock and a hard place or between an engine and an exhaust pipe. I don't know shit about cars, but I'm trying my best over here. What I do know about, however, is the Bank of Japan. And the Bank of Japan knows how to get the job done. So this is an interesting central bank. We all know Japan, of course. It's a country. It's an island in the Pacific Ocean. It's off the coast of China and Russia. Two countries who they have quite the layered history with. Let's call it that for now. But basically, they came out with a report yesterday in the equity portfolio for the Bank of Japan officially reported the largest gains that they've ever reported in their history. So just to restate that, the Bank of Japan had their best investment year of all time in 2023. So yes, the Bank of Japan, you might be wondering, what the fuck, a central bank buys stocks? Yes, they do. So it's mostly through index funds and ETFs, but it's exactly the same thing that the Federal Reserve did back in 2020. Only Japan's been doing it since 2010, and it's pretty much the only reason that their stock market has been moving higher. So let's take a step back. We know the Japanese economy. We kind of know what's going on there. Lately, we've spent a lot of time talking about population pyramids. So again, population pyramids, this is graphing the percentage of the total population of the country on the x-axis and the age ranges on this y-axis right here. So the wider it is, the higher percent of population is dominated by that age bracket. So we can see the largest one is right here, 45 to 49. The second largest is like 70 to 74. It's a bunch of fucking old people. Larry Summers said it best in saying that Europe is a museum, Japan is a nursery home, China is a jail, and America is a fucking bomb or something. I forget what he said about that, but that would actually be a pretty good one. Anyway, this is their population pyramid. And so we can see it's very heavily weighted towards the older age groups. And basically, what does that mean? I mean, that means that Japan's population pyramid is essentially equivalent to this right here. And that is to say that it is complete dog shit. So don't let the fact that this guy is completely adorable distract you from how terrible this population pyramid is. But these, you're looking at the exact same image right here. It's like Patrick Star identifying the differences in those images. There are no differences. They are the exact same picture. I don't think that was Patrick Star, actually, though. I'm pretty sure that was Kevin from The Office, now that I think about it for a second. But basically, when you have an economy like that, I'm gonna go to the next picture, because I don't want that dog shit to just be fucking sitting there. Anyway, the reason that you don't want a population pyramid like that is because it's young people, working people, tax-paying people who create economic growth, and especially because elderly people tend to be more of a drain on the economy than they are contributors to it. They're big spenders, don't get me wrong, but they spend money a lot of the time that they receive from the government via, you know, whether it's healthcare, whether it's Social Security or the Japanese equivalent of Social Security. I'm sure their system is way better than ours because, you know, we set such a low bar. But effectively, when you have an economy that's this old, it's going to be a drag. So that's why you see growth rates like this. This is actually the Japanese inflation rate for all of its history. Completely ignore everything before this point. So we're looking at this era right here. It's up and down, basically no inflation from, call it, you know, honestly, call it like 1993 right through until about like 2022. There's basically no inflation, no economic growth whatsoever. Believe it or not, a little bit of inflation is actually a good thing. It's the reason you want a little bit of inflation is because you can't really keep, prices are never going to remain totally stable. And you want a little bit of inflation because that shows that output is growing. If we had the opposite, if it was deflation, nobody would be buying anything. So with inflation, there is some encouragement to spend because you know it's going to be more expensive a year or 2 years from now. Whereas deflation, why would you ever buy anything? Because it's only going to get cheaper from that point forward. So Japan, they had to do some things a little bit differently in order to spur their economic growth, and one of those things was buying equities in order to basically signal to investors they're confident in the country, to encourage spending, wealth effect, all that kind of bullshit right there. And that's how you get something like this. This is the entire history of the Nikkei 225, which is basically the Japanese equivalent of the S&P 500. As we can see here, it hit its previous all-time high in 1989, which is, I'm pretty sure that's technically a BC year, but anyway, it's been, you know, throughout all of these trials and tribulations, they finally hit a low point here in roughly 2010 to about 2012. And what do you know? That's exactly when the Bank of Japan started to buy stocks, and it's been a strong march upward since then. They officially set a fresh record high in February of this year. So clearly, it's working out pretty well for them over there. The economy, that's a different story. The stock market is not the economy, but still, it's good to see that the Bank of Japan actually managed to make some money after those years and years and years of negative interest rates that they were offering their population. Okay, that about does it for us today. Of course, we want to leave with a quote from none other than who people apparently call the Warren Buffett of Japan. This is a short one for us today, but it's a powerful one nonetheless, and it'll probably get you fired up on this Thursday morning. 𝗏𝗏𝗧𝗪𝗏, I'm pretty sure that's how you pronounce it. He said, "There is no end in the money game." I'm looking for the starting point to the money game personally, so if anybody could point me in that direction, that would be great. But for now, I'll just say happy investing, happy trading, shout out to all of you apes, and have a wonderful rest of your day. We'll see you tomorrow.